Hello, today is Tuesday and it is the 22nd of May 2012. Within this video, I'll start off within the weekly chart of silver, go over about 2 or 3 points that I want to go over, and then finish it off within this some notes that I made yesterday. I decided to get Notepad out, copy and paste some stuff, as well as write some things down, which start off within a comment from yesterday's video. Go over this information a little bit later on, really not that much later on, regarding money supply, debt numbers, stuff from the US debt clock, etc. So one of the few key points on this chart that I want to go over, one is this formation that occurred last week, which is like a hammer formation. That is where the close is pretty close to last week's close, and it had a decent size down move like this. Normally a bullish situation. Not uncommon to start off the following period with a red candle like this, or even having a few periods that don't have its gain first. What's important is the 61.8% Fibonacci from this high and this low, which happens to work out around 27.55. We'll round it to 27.5. Therefore, if it breaks below it and holds below it for more than 4 or 5 or 6 hours, definite reason for concern, as oftentimes a failed move can create a fast move, and the failed move to not create higher gains from a nice setup could very easily create a fast move in the opposite direction, which would be lower. Some other things to point out. I'm actually going to do that second. Before I go over that, I want to just go over this down move. There has been several weeks since the last week of February, and only 2 weeks that have actually had gains, and they were very minuscule. This week in here was a gain of 2 cents. This week was a gain of 12 cents. So therefore, since this week in here, silver has not even come close to gaining more than 0.5% for the week. Now the moves that occurred back last year at the top, this was the size or the direction of the move for the week. If we match this up within this week, well, it was actually longer if you put in perspective from when the top and the bottom occurred, because it was about a 3-day move from this high to this low. Now, if we match it up within this high in here, well, it happens to work out to move down to pretty much this low. So the moves that used to occur in 2 days or 3 days or 5 days is taking a few months, close to 3 thus far, to come into play. Alright, so let's get started within this information in here. I had some comments yesterday on my on one of my videos that I made, which I'm glad I did, because this gave me a reason to do some research and go over the research within this video, because let's get started. So the comment that I received by a user was this one in here. Curious about your thoughts. Why should silver be increasing in price? Monetary inflation? If so, how much has there been over the last 10 years compared to silver price increase? If it's supply and demand, then total cost of production seems to be around $19 per ounce. So how does one gauge where price should be? I say fair price is around 11 to 13 per ounce. Either mines will shut down, technology will improve, monetary inflation, or a combo to elevate prices down the road. Okay, so that was the first comment. Now I replied back stating, considering this is a short-term video, because yesterday's video was only based on the very short term, really the 28 to 29 level, and you have much lower numbers, then I find it a little odd. It's not really the value of the silver really for the long-term prices, but the value of the fiat currency and massive inflation. See, this is personally why I'm getting into silver, because it's an anti or a play against that of fiat currency. In the end game, my price is not for silver to go higher nor lower, but to be priced in at div/0, as you cannot divide by 0. Now, div/0 is something you learn in grade 4 or 5, where if you take any number divided by 0, then you can't get a number, which is something that really doesn't exist. And in reality, a price movement to that would pretty much be a guarantee that the final price would be exceptionally high. But that's long-term thinking. And we'll get more into that later on. I got a reply back. I just happened to add my comment now, but I've been watching your vids for some time now. My calculations were based on the increase of the money supply as measured by base M1, M2 between 2002 and today, and what the approximate price of silver was, 4.5. Based on that, the money supply has increased approximately 250% plus. Now here's an interesting thing. Now, why does the price in 2002 happen to be the one that we start at? Why don't we start at 2005 or 1994 or 1991 or 83 or 74 or 62 or 55? Why does it have to be 2002? I replied back by stating, how about from 1913 to today? If the money supply increasing has to bring higher prices, then why a 92% down correction? Because in 1980, the price was 50. 90% down, well, that's going to 5. Well, it broke below 5, so I didn't do the math. I just, by using a calculator, I did my math by quickly rounding it in my head. So it might be 93, it might be 91, whatever. It was a break of 90. And then I get a reply back, well, it was 4.5 ounce. Was it an accurate price in 2002? Well, in fact, I'm going to probably even say no. I think closer to 4 or 4.25 was accurate. But yeah, I'll say 4.5 was accurate. Or was that too low? Well, it definitely wasn't too low then. It was, if anything, it was a little too high. Of course, the money supply has increased, but to what extent over 100 years? 1,000%? Well, 1,000%. It's actually a little higher than that, and I got the numbers here with the reference links. But we'll go over that in just a little bit. Another person commented, stating 11 to 13 ounce will likely not occur again until the end of the secular bull market that started in 2002 and should continue until around 2020. At this point, the silver market has near unbreakable support at 18 to 20. If silver does tip down to the 20, the Chinese will gobble it up faster than Americans gobble Chinese food. Then we will see a steady road to 70 to 80 an ounce. These are my humble estimations. We'll see who's right between us, but 11 to 13 seems totally unrealistic, although it would make me happy. Now, let's go over this part just a little bit because I don't know what word to talk about 18 to 20. Quite frankly, the one thing I said in a few videos ago recently is that if you're playing this game, you don't want to play too many setups. Therefore, you want to find the setups that have amazing probability odds. And quite frankly, silver price action going between 18 to 22, 23 is a better range for me. That is one of the ones you'd want to play because the probability odds are extremely high that it doesn't retrace much lower from those levels. Now, as far as 11 to 13, I can see it being possible, but unlikely. I did a video a few weeks back as far as possible outlooks for where silver may go, and one of them was to go extremely low in this range. And if you want to see more on that, you can just check that video out. So I did some research, and I found this webpage, www.thetrailofgreen.com/#about. Some information that I came up with, and this might be a little hard to read, so I'm definitely going to explain it. The national debt back then was $3 billion. Today it's $15.7 trillion. That's approximately, that's what A stands for, that's approximately greater than 5,000 times higher since 1913, or up 1 million in a minute, greater than 1 million a minute, or less than 2 days it takes for $3 billion today. Because the national debt back then was $3 billion, we could do that in less than 48 hours. What I did yesterday is I recorded the national debt screen and just seen how long it would take for the national debt to go up in a minute, and I pretty much came up with around 50 seconds. Interest expense is something that you would find on that webpage. Back then it was 200 million. Today it's 400 billion, which is approximately 2,000 times greater than it was then. And $200 million today works out every 6 to 7 hours. Now, one of the things that I really talk about on this page is to really educate yourself on how fiat currency is created. For the information or research that I have done is that is 100% guaranteed because only central bankers can mine fiat currency. Therefore, because they monopolize the supply and they charge interest, this interest does not exist on the physical supply of cash anywhere Thus, it could only be debt, and that's why our debt explosion problems are so massive. Therefore, when I read on different headlines about ways of getting the budget deficit in order, I don't know if I'm going to laugh or throw up when I hear it, because it's impossible when we have a system that guarantees what we're seeing today. Moving on, M2, which is the money supply figures. In 1913, it was 16 billion. Today, it's 10 trillion. So 1,000%. Well, this is approximately 600 times greater. So that's about 60,000%. So that's a little bit higher than those estimates. And that's 1,000,000 in 37 seconds from one recording yesterday. Now, M2 to bank ratio, I was going to talk about it. I'm already past 10 minutes, so I'm not. USDebtClock.org, I went on there, and there's some quick little numbers. The national debt since the year 2000, or about 12 years in duration, has went up a little under 3 times its value. So it's almost tripled in 12 years. The debt per citizen has almost went up 2.5 times. The GDP has gained greater than 50%. The total interest has also gained a little more than 50%. U.S. total debt is greater than double. U.S. Federal Reserve monetary base is greater than quadruple. The M2 is less than double and less than 1.5 times. Official unemployment is greater than double. Actual unemployment is less than 2.5 times. And food stamps is greater than 2.5. Now, what's interesting is this information comes from the U.S. debt clock. Now, if you have a situation, say, just using a different example, someone's been drinking a lot and the person who he's going home to see does not approve of that person drinking and he's just wasted drunk. Person comes up and asks, how many beers did you have tonight? Well, the person who's drunk knows this person doesn't approve of them drinking, but also knows that they're wasted and cannot lie and say, I didn't have anything to drink. But quite frankly, there's a good chance that the number they state is much lower than what it actually was. For if the person says, well, I had 6 beer, you might want to double it. Just something to think about. Other different numbers that I've seen on the web page, and they didn't have these numbers for 2000. Unfunded liabilities was 119 trillion. Total assets, 84 trillion. So that's, as far as my accounting stuff that I remember, when assets are lower than liabilities, that means your owner's equity is a negative, because owner's equity is equal to assets minus liability. Another thing is currency and credit derivatives, 725 trillion. Well, wow, that's what, 30 some odd percent away from a quadrillion? Interesting to know. Here are a few dates that might be important if you want to research history. I enjoy history, actually. I'm a big fan of history, more on the evolution side of it and the scientific part. But with that being said, here are a few dates from 1907 to really the 1940s. And all of these events had a lot to do within the Federal Reserve. Panic of 1907. You know, Federal Reserve Zeitgeist addendum was stating off that this was an inside job, to say the least. Now, whether it was or wasn't, I haven't done too much research on it. But I do realize there was a lot of research put into that film. Jekyll Island in 2010. That was to create the Fed, which was done in 1913. Okay, this isn't done in order, so I can just fix that. And the Fed was created in 1913. Now, 1912, talk about an ingenious decision. Now, I'm saying this on a negative level too, but if you look at a name called John Astor, I'll type it in. John Astor. Interesting fellow. He died on the Titanic, and well, he was like the Ron Paul of today, who would have easily opposed the Federal Reserve. Well, kind of a little coincidental that right in between the Jekyll Island meeting and the Fed being created, he happened to have perished in the Titanic. 1914, World War I, very much funded, both sides of the war, of course, by you-know-who. 1932, economic collapse. 1933, the FDIC started. That was the start of fiat currency, in my views. And 1940s, at least the first half decade, World War II, same thing as World War I. And I just stopped making dates at that point because I can keep on going further. And I might just write a whole bunch of them and then have the computer sort the years for me later on. I don't know yet. Here's a question for you. Where was Ben Bernanke on November the 5th, 2010? If you want, do a quick search and see if you can find the answer in less than 60 seconds. Okay, so pause the tape, search, we're done. If you search that day, this is what you might find, especially if you searched it quick. Reuters, I pronounce that wrong usually. Fed Reserve Chairman Ben Bernanke on Friday defended the U.S. Central Bank's bond buying against beggar thy neighbor criticism, saying the return of a strong U.S. economy was critical for global stability. In a future video, I'm going to talk about strong economies, weak economies. Quite frankly, the economy is nowhere near strong, but that's for a different video. But if you go to the Jekyll Island Wikipedia page, you'll find on November 5th and 6th of 2010, Ben Bernanke stayed on Jekyll Island to commemorate the 100-year anniversary of this original meeting. Some quick little stats. From the end of November 2009, I don't know why I put this in, but just something to do. Since then, gold is up less than half, silver is up a little more than half, platinum is up less than 2%, palladium is up less than 75%, Dow is up less than 20%, the US dollar index is up 8%, and crude oil is up 20%. When the US dollar index goes lower, then what normally happens is the price of these commodities would really increase. But when it goes higher, then that means that the price of these things should go sideways, up a little bit, or down, and they went up a little bit. So that'll be it for today's video. I knew it was going to be a little bit long, and now we're closing in on 18 minutes or so. So I'd like to thank you for tuning in, and have yourself a magnificent day. And finally, when I talk about different research, for example, if I see something that says, I say it should be this, whatever, I don't care what anybody says. I got to do my own research, come up with my own conclusions. And that's the best way to figure stuff out. Therefore, my conclusions is that we have been in a crime-based economy, and the banks have been doing the robbery right in front of us. Now, I don't know why it's been several hundreds, over 1,000 days since the information for the big scam has been easily accessible throughout the internet, and people haven't understood that. I can't figure that out. I would like to know, but as of now, I can't figure out why it's at this level. But there are people that do seem to care. The Occupy Chicago's been doing very well, and I'm just rambling on, so I'm going to finish off by stating I urge you to do your own research and have yourself a great day. Bye-bye.